I had another inquiry the other day about EBITDA versus free cash flow versus net income versus profit, profit and loss statements versus income statements. There's a lot of different language bantered around in the financial community by accountants, the nerds that do appraisals, people like me. Every appraisal company does it different. One uses a discount future cash flow, one uses salvage value, another one uses return on investment. I use a multiple of free cash flow and gross income. What's the other guy? He does, oh my gosh, I can't come to it. There's just so many, I can't even keep up. And there's more people coming into the market. So I know it's very confusing. I just want to break it down to the bottom line. The bottom line is, what's the income of the business? The legitimate income that's being charged and collected. And charges are one thing, collections is another. I've toyed with the idea of converting my entire appraisal system to collected amounts, not charged amounts, only because it seems to be an ever-increasing trend that there's a lot of accounts receivable in some practices, and some of it is completely uncollectible. Why even appraise it? That's another topic for another day. Nonetheless, let's start with the top line. What is the practice generating a revenue? And perhaps we can go to what it's collecting. And the difference will be the accounts receivable. What it doesn't collect from charges, the difference is accounts receivable, and then you need to look at the aging. That's another topic. I'm getting off track already. Let's talk about the bottom line, though. What's the top line? What are the expenses? What are the true, actual operating expenses of the business? And in order to get to that, we take out things like personal expenses of owners, very extensive continuing education, automobiles, some insurances are putting through dental corporations that are really not business insurances. They're personal. They're related to the operator. And when the operator goes, those insurances no longer exist. You as the new operator may want to put them in, but we take them out because they're not essential. They're not mandatory. They're not reoccurring in many cases. For example, people that buy those whole life policies, they put a big chunk through in 1 year. Talk to your life insurance advisor about that. Spousal salaries, children, relatives, we've seen it all. All business owners in Canada are doing this. It's not just the dentists of Canada. So we need to know that we need to normalize. So we take the top line, the revenue, deduct the actual operating costs, adjusted for all of these non-essential, non-reoccurring costs, and then you have cash flow. Now from that, certain people say, well, we want EBITDA, so we have to add back all the debt and the interest charges, which we do that in the free cash flow method anyways. There's no difference between mine and theirs that way. But the EBITDA thing, they have to take out a doctor's salary. They have to put in a notional salary or an income for doctors. Could be more than one doctor in the practice, could be 10. And they pay them all 40%, which is patently flawed. That's another topic. So then in EBITDA, they just come down to free cash flow minus doctor earnings. My method is just free cash flow. So top line minus legitimate expenses, free cash flow. In EBITDA, they go top line minus legitimate expenses, minus doctors, EBITDA. So EBITDA is lower than free cash flow. It's just now it depends on the multiple. The EBITDA people are throwing up multiples 6, 8, 10 times EBITDA. I'm in the free cash flow world using 1.5, 1.3, 1.7, sometimes up to 2. So I just use lower multiples on a higher number. They're using higher multiples on a lower number. It's just mathematical gymnastics. Don't get confused. In the end, the liquid test of anybody's opinion of value, regardless of what methodology they use, is will the bank finance it? And is there a debt service calculation ratio in there? They have total debt TDSR, total debt service calculations, gross debt, gross GDSR, personal debt service calculations. There's many ways the banks do that. Bottom line is can you pay the bank, can you pay yourself? And if you can pay yourself 100, the bank wants to know you can pay them at least 75. If you can pay yourself 200, the bank needs to know that you can pay them about 150. If you can pay yourself 300, the bank will say, well, you can probably pay us just over 200,000. Do you see the ratio there? The more income there is for you, the more room there is to pay the bank. But if you can't pay both, the bank won't do the deal. I don't even know if that made sense. That's the discussion. I was trying to answer a long text from a very intelligent young dentist who's really trying to figure it out because he's doing so much research. He's hearing all this nonsense and getting appraisals from so many companies. He's getting his head spun around in circles. I can help you if you need to know more. Timothy Brown, CEO of Roy Corp. Thanks for watching.